the 7-asset contract. The Chicago Mercantile Exchange just authorized the first single contract that allows institutional desks to trade 7 different cryptocurrencies simultaneously. Announced on May 14, 2026, this new Nasdaq CME Crypto Index future marks a departure from the days of trading Bitcoin and Ether in isolation. By bundling Bitcoin, Ether, Solana, XRP, Cardano, Chainlink, and Stellar into a single cash-settled instrument, the exchange is effectively turning a fragmented market into a unified asset class. This is not just another trading pair. It is the arrival of a professional-grade benchmark that forces the largest liquidity providers in the world to treat the crypto ecosystem as a single, coherent index. And the internal mechanics of this weighting change how capital flows across different chains. Market cap weighting mechanics. Unlike a simple basket, this index uses a market cap weighted methodology that is recalculated every single quarter. This means the biggest players like Bitcoin and Ether still command over 90% of the weight, but it creates a regulated entry point for high-performance assets like Solana and Chainlink. Think of it like the S&P 500 for the digital economy. If an asset loses its market share, it is automatically trimmed from the index, and rising stars are added. This mechanical rebalancing ensures that institutional portfolios remain aligned with the actual distribution of on-chain value, without the fund managers having to move a single private key. However, this level of automation brings a new kind of volatility to the smaller assets in the basket. The rise of institutional beta. Institutional demand is no longer about picking the one winning horse. Average daily volume for crypto products on the CME has surged 43% since the start of 2026, signaling that the smart money is pivoting toward beta exposure. In finance, beta represents the overall movement of the market. Investors are tired of the risk associated with individual protocol bugs or regulatory targeted actions against single coins. By buying the Nasdaq index, they are betting on the growth of the entire sector rather than the success of a single CEO or foundation. This shift toward indexation is the clearest sign yet that crypto has moved from a series of experimental tech projects into a mature, diversified financial sector. But this new systemic approach comes with a hidden cost for the underlying protocols. The paper crypto paradox. There is a significant catch to these new index futures. They are cash settled, which means no actual Bitcoin or Solana is ever delivered to the buyer. Critics often call this paper crypto, arguing that it creates a massive derivatives layer that could potentially decouple from the actual price on-chain. If millions of dollars are moving into the CME index instead of the spot market, the actual demand for the tokens themselves might be dampened. But the counter-argument lies in the arbitrageurs. Professional trading firms constantly trade the difference between the CME price and the spot price on exchanges like Coinbase or Kraken. This ensures that every institutional dollar flowing into the index eventually forces a corresponding move in the physical market. Even so, the reliance on cash settlement creates a buffer that purists find dangerous. The Era of Global Indexation. The launch of the Nasdaq CME Crypto Index Futures is the definitive signal that we have moved past the Bitcoin-only institutional era and into the era of the digital economy as a diversified commodity. By referencing the mechanics of market cap weighting and the 43% surge in volume discussed earlier, we can see that institutions are no longer looking for a digital gold alternative, but for a systemic entry into all top-tier protocol liquidity. For the viewer, this means the days of altcoins moving independently of the majors are numbered. As more capital enters through these broad-based indices, price correlations between the top 7 assets will likely tighten, making it harder to find uncorrelated alpha in the top 100 tokens. The real movement to watch now is the first filing for a spot ETF based directly on this index. Keep a close eye on the SEC's response to the first NCI-linked spot filing expected by the end of Q3 2026. Subscribe for more.